Scene script. Have you ever wondered how global tensions impact the stock market? Today we delve into the unexpected rise of the Dow despite the ongoing Israel-Hamas war. A fascinating world of finance, isn't it? Now let's talk about the big players in this game. Federal Reserve officials like Vice Chair Philip Jefferson and Dallas Fed President Lori Logan have struck a cautious tone on further rate hikes. They're emphasizing the need to balance tightening with potential economic slowdown risks due to tighter policy. It's a bit like walking on a tightrope, isn't it? They have to keep the balance just right to avoid any economic tumble. But let's throw a little more uncertainty into the mix. The ongoing Israel-Hamas conflict has added a new dimension to market uncertainty. This conflict has put a halt to the optimism about potential normalization between Saudi Arabia and Israel, which could have been a significant step towards resolving the long-standing Arab-Israeli conflict. Now you might think, well, that can't be good for the markets, right? But here's where it gets interesting. While these geopolitical tensions might seem like they should spell disaster for the Dow, that hasn't been the case. We've seen a surge in defense stocks such as Lockheed Martin, L3Harris Technologies, and Northrop Grumman, with expectations of increased defense spending growing amidst these tensions. On the energy front, Chevron saw a 3% increase as the Israeli government ordered the shutdown of natural gas production at the Tamar platform in the Mediterranean. Rising oil prices due to Middle East tensions also gave energy stocks a boost. But it's not all rosy. U.S. airlines like Delta Airlines, United Airlines Holdings, and American Airlines Group took a hit after canceling flights to Israel due to safety concerns amid the conflict. In the tech world, Intel is facing challenges. Concerns are mounting that the Israel-Gaza conflict could impact its plans to build a new chip-making plant in Israel. As we observe, global tensions don't always mean a dip in the market. Rather, it can lead to surprising surges, as we've seen with the defense stocks. Taking a closer look, geopolitical tension led to a surge in defense stocks, including Lockheed Martin, L3Harris Technologies, and Northrop Grumman. The ongoing conflict between Israel and Hamas has undoubtedly shaken the market, creating an atmosphere of uncertainty. However, in the face of this uncertainty, one sector seems to be thriving: defense. Defense stocks have seen a significant boost, with major players like Lockheed Martin, L3Harris Technologies, and Northrop Grumman experiencing a surge. Anticipation of increased defense spending is one of the primary drivers of this uptick. In times of geopolitical tension, nations often increase their defense budgets, leading to higher revenues for companies in the defense sector. It's a classic case of one man's fear is another man's fortune. But the defense sector isn't the only one capitalizing on the current situation. Energy stocks are also on the rise, with Chevron leading the pack. The Israeli government's decision to shut down natural gas production at the Tamar platform in the Mediterranean has had a significant impact. This shutdown, coupled with rising oil prices due to the unrest in the Middle East, has led to a 3% increase in Chevron stock. The energy sector, much like defense, tends to thrive in times of global tension. As nations prepare for potential conflict, the demand for energy increases, pushing up the price of oil and gas. This increase in price then translates into higher revenues for energy companies. In conclusion, while the current geopolitical tension between Israel and Hamas is causing a great deal of uncertainty and concern, it's also creating opportunities. Defense and energy stocks are seeing substantial gains driven by the anticipation of increased defense spending and rising energy prices. It's a stark reminder of how interconnected our world is, and how events in one part of the globe can have far-reaching effects on the financial markets. Rising oil prices due to Middle East tensions have given a notable boost to energy stocks. Scene script. However, not all sectors are celebrating. U.S. airlines have suffered losses after canceling flights to Israel due to safety concerns amid the conflict. In the midst of this geopolitical turmoil, the airline industry is facing significant turbulence. Major U.S. airlines, including the likes of Delta Airlines, United Airlines Holdings, and American Airlines Group, have all experienced setbacks. These airlines had to make the tough decision to cancel flights to Israel, a move driven by the escalating safety concerns amidst the conflict. This has not only disrupted travel plans but has also led to financial losses for these carriers. The cost of these cancellations is yet to be fully calculated, but it's clear the airlines are feeling the pinch. Now let's switch gears to the tech sector. Intel, a leading player in the technology industry, is also grappling with challenges directly linked to the conflict. The tech giant's plans to build a new chip-making plant in Israel are now under a cloud of uncertainty. As tensions heighten in the region, concerns are mounting about the potential impact on Intel's ambitious expansion plans. So, what does this mean for Intel? Well, a delay or even a cancellation of the chip-making plant could disrupt Intel's supply chain, potentially leading to product shortages and increased costs. This could also have a ripple effect on the broader tech industry, considering Intel's key role as a supplier of semiconductors. It's a tense time for both Intel and its stakeholders as they wait to see how the situation unfolds. It's clear that the ongoing conflict in the Middle East is having far-reaching effects, touching industries that many of us wouldn't immediately connect with the geopolitical situation. For the airline and tech sectors, these are challenging times. They are grappling with significant setbacks and facing an uncertain future. These developments remind us of the interconnectedness of our world and how global events can have profound impacts on industries and economies. Tech and airline sectors have been hit hard by the ongoing conflict, raising concerns about their future prospects.
In other news, NVIDIA has canceled its AI summit scheduled for Tel Aviv, Israel, adding to the list of disruptions caused by the conflict. This decision comes as no surprise given the ongoing geopolitical tensions. The summit was anticipated to be a platform for the latest advancements in artificial intelligence, showcasing NVIDIA's cutting-edge technology. The cancellation certainly throws a wrench into NVIDIA's plans, but the safety and well-being of all participants is paramount. But let's shift gears and talk about Tesla. Tesla, the titan of electric vehicles, has hit a bit of a speed bump. In September, Tesla's sales in China took a 10.9% dip. This is notable considering China's significant role in the global electric vehicle market. However, it's not all doom and gloom for the electric vehicle industry in China. Chinese electric vehicle maker BYD actually saw a substantial sales increase during the same period. Now, Tesla's stock did take a slight hit due to the sales decline. But remember, this is Tesla we're talking about. They've faced numerous challenges and always managed to power through. Tesla's CEO Elon Musk is known for his resilience and innovative strategies. So while this dip is noteworthy, it's not a definitive indicator of things to come. It's a dynamic landscape, folks. On one hand, we have a major tech event cancellation due to geopolitical tensions. On the other, we have fluctuations in the electric vehicle market with Tesla's sales dipping and BYD's sales rising. These developments further underline the wide-ranging impact of geopolitical tensions on the global economy. As we continue to navigate through these turbulent times, one thing is clear: the world of technology and finance is more interconnected than ever before. Despite the turmoil, some companies like ARM Holdings managed to maintain stability. Amid the flux of the market, ARM Holdings stood as a beacon of resilience. Analysts from Wall Street, including those from Goldman Sachs, have been vocal about ARM's potential for growth across various markets. The company's stability, even in the face of mixed factors, is a testament to its robust business model and forward-thinking strategies. However, the same cannot be said for all companies. Shifting our focus to China, we find Country Garden Holdings grappling with offshore payment challenges due to debt restructuring. The company, a significant player in China's property development sector, has been under immense pressure due to its debt burden. It's currently unclear whether the company managed to meet a substantial bond coupon payment of $66.8 million. This financial strain has seen the company's shares plummet over the course of this year. China's property market as a whole is feeling the heat. The pressures of debt are pushing more developers towards seeking debt extensions and restructuring their financial obligations. Country Garden's predicament is indicative of the larger trend within the market. The company has even secured approval from onshore bondholders to extend bonds worth 14.7 billion yuan, roughly translating to $2.02 billion. This trend underscores the severe financial stress experienced by property developers in China. It's a stark reminder of how global geopolitics and economic uncertainties can have far-reaching impacts affecting industries and markets across the world. As we wrap up, the stock market continues to be a reflection of the unpredictable nature of global geopolitics. It's a dynamic arena where companies rise and fall, where stability can sometimes be a luxury, and where the resilience of businesses is tested against the backdrop of global uncertainties.